Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be the mayor, the governor himself, Mr. Michael Becker, but he is, again, in self-isolation at his house. And I think he's coming out one of these days. And so, unfortunately, he couldn't be here today. So we are going to be joined by John Brixon with Old Capital. So, John, how are you?
Hey, Paul. Doing well. Just holed up in my bunker here trying to close some loans.
John is a master of closing loans, and he's been on the podcast a number of times. But if people haven't really heard your voice before, John, can you kind of tell us a little bit about your background and when did you join us, and a little bit about your history?
Sure. I joined Old Capital in February of 2018. So I've been with Old Capital for just over 2 years now. I've been in commercial real estate finance for about 8 years now. Joined a bank once I graduated out of college in 2011. Worked in the bank for 3 years. It was a large regional bank in the Chicago market. Relocated to Dallas in 2014. Worked for a couple of different real estate private equity firms, doing lending on behalf of those real estate private equity firms. And then a couple of years ago, joined Old Capital. And yeah, it's been a great ride. And obviously different times now, but I think we're well positioned in the market.
Yeah, John's done a wonderful job keeping everybody informed about what's going on. He's constantly on the phone talking with all of his clients about what's happening in the capital markets and if deals are trading and what kind of terms are available out there. So don't forget to contact John Brixon with Old Capital just to get his inside information. So we're blessed to have John with us on the team. So we're looking forward to listening to John, at least on this podcast. Also, too, don't forget, if you get back to the oldcapitalpodcast.com website, oldcapitalpodcast.com, we have about a 17-page white paper report that was written by James Eng, the professor, Paul Peebles, myself, Michael Becker, and also John Brixon. It is a great white paper report that kind of goes into detail what you should expect when you're financing properties, and especially during these turbulent times. It is probably the best thing to have somebody hold your hand, and that white paper report does go into great detail what you should be expecting, how to finance not just multifamily properties, but office and retail type of stuff. But go to the podcast website and then download that too, plus Michael Becker's checklist and what he puts out for whenever he's doing a purchase sale agreement, what he expects from the seller to give to him for due diligence. So it's his due diligence checklist. So that's a real good one too. So on the podcast today, we have a friend of ours that has done a couple transactions with us. In fact, he's a client of John Brixon's. And I thought we would just kind of get to know him a little bit and his background, what he did before he got into multifamily, and then how he's been so successful in his last couple of years. And these guys on the East Coast, he's done a great job, and he's bought some properties down on the Eastern Coast border. And he's a guy that he's done a great job. So I want to talk to Bill Brancucci. Bill, thanks for being on the podcast. Thanks. We appreciate that.
Thanks for having me, Paul. Thrilled to be here.
Yeah, thanks for Bill for being on the podcast. We appreciate it. I'm going to kick it over to John, and let's talk a little bit about multifamily. So go ahead, John.
Sure. Thanks, Paul. And Bill, thanks for joining us today. As Paul had mentioned, Bill is active in the Southeast, has about a 1,500 unit portfolio across the Carolinas and Georgia. But Bill, maybe you could just tell us a little bit more about your group, Citadel Real Estate Group, and what markets you're active in, and also provide some background on yourself and how you got into multifamily and how long you've been in the business.
Okay. I'm going to start with just a little history. I grew up in Cambridge, Mass, right next to Boston. My mother was a landlord, and she had to navigate rent control in the 70s and 80s with rent control and, a pretty progressive political climate, to say the least, in Cambridge. And then I went to school in upstate New York. And after graduation, I went to New York City, like just about everyone I knew, to go to Wall Street, not to pursue real estate. And Wall Street was extremely cutthroat, but very educational. But I always had an interest in real estate. So I went through NYU's real estate program, which was great. And I did some grad work at Wharton. And then I went to work for a developer named Bruce Eichner in the early 90s. And I worked on several skyscrapers that he put up, but I also watched him lose two of them to foreclosure during a recession in the early 90s. So I learned early on about risk in real estate, but it was a phenomenal experience, and it was nothing due to them. It was simply hitting the market at the wrong time. And back then, you could build million-square-foot office buildings with no tenants and almost none of your own equity. And lenders were eager to lend to it. And they learned the hard way that wasn't a good business model. So after a couple of years working with the developer, I was back on Wall Street, ultimately with the plan of going back to real estate, which was really my true love. And to fast forward around 2013, I started attending a lot of real estate workshops, because in the post-2008 financial crisis, it seemed like everyone was in the fix and flip business, buying houses, rehabbing, and flipping them. And that didn't really interest me, but multifamily really did. And I formed Citadel Real Estate Group in 2015, feeling that I had enough knowledge, I had enough contacts that I could launch a business. And so I did with some associates. And so we started in 2015. That was the year we did our first acquisition, at the very tail end of the year in December. And I'm happy to tell you about that deal if you want to know more. Or
yeah, please.
So, and I want to detour because everyone has a slightly different business model, but we were impacted by just an old timer who said, hey, Bill, you want some advice? Which I didn't ask for. He said, stick with the bigger stuff, 150 units or more. Don't play around with the small stuff. And that kind of validated my own little belief system. And yet I know there are many good smaller deals, so I'm not knocking them. But for us, that was a good fit. And of course, right out of the gate, I decided to break the rule. My first deal was a C- property in Atlanta. It was 118 units. It had been foreclosed on by Fannie Mae, so we bought it out of their foreclosure real estate owned portfolio for about $3 million. And we held it for 2.5 years, rehabbed it, and sold it for about $5 million. And we violated one of Mike Becker's rules, which was don't buy in the hood. And this was a pretty rough property. It had rough tenants, it had crime, it had everything you don't want to see in a property it had, but we bought it at such a good price that it was really hard to not make money. So I think our investors had an IRR of about 30% per year for a 2.5-year hold. So they were thrilled.
Wow, that's pretty good.
Yeah. So you bought it for about $25,000 per unit, pretty low price in the Atlanta market. Yeah. What was your total rehab on that project? And coming out of that, aside from wanting to buy larger properties and, not wanting to buy in the hood, was there anything else that you learned on that first transaction that you carried forward?
Well, the one thing that doesn't fit on a spreadsheet is that your property manager can kill you or save you in a deal. And so having the right property manager is gold, and not everyone is cut out to do, C properties in the hood. It takes a certain type of manager that knows what they're getting into, doesn't freak out when there's a car theft or gangs or anything else, because it comes with the territory. And so you need to know that going in. And yet the returns can be better than ever if you go in eyes wide open. But this property had everything that could go wrong, and yet we still made money because I think we bought it right. We're fundamentally value investors. And buying right really will allow you to make a lot of mistakes and still come out on the good side of the transaction.
Sure. And you've been pretty active in the Atlanta market since you've been buying multifamily. How many properties do you have in Atlanta? And why Atlanta? You're based in New York City, but why have you decided to target the Atlanta market, and what do you like about it?
So, we're big in Atlanta and also South Carolina. They're adjacent, as you know. The two or three things that I really look for first is strong demographic trends, which Atlanta really has. I think it's second in the country for net immigration in. Second or third. I think it's Dallas. I think then it's Phoenix, and then I think Atlanta's the third. So the demographic trends were phenomenal. The business climate was great. There's a lot of companies moving there, and I think they have over 100,000 net residents moving in. So it was about 2,000 people a week moved to the city of Atlanta, the metro area. And the trend isn't as strong in South Carolina, but South Carolina is also finding, big companies, BMW and Volvo and Airbus, and Boeing moving there. And same thing, migration. And then the other key thing is a very business-friendly climate and no rent control. Rent control, to me, is just, I think, one of the worst things you can do to a real estate market. Whatever you think you're going to fix, you're going to actually make it much worse. So we wanted to avoid markets where there was rent control also.
Sure. Yeah, no, the Carolinas have been a great market over this last cycle. And, even the secondary markets, I mean, obviously Charlotte and Charleston are great markets, but even the Greenville, South Carolinas and the Columbia, South Carolina, and, you've acquired a couple of properties in the Columbia market now, but even those smaller markets in the Carolinas have been great.
Yeah, very strong. They're not too crowded, and there's definitely more investors than we've ever seen before. But some markets were just so crowded, and we can go to that. But I've bid on deals in crowded markets and been just, it's hard to stand out when there's 25 other bidders in the same deal you're looking at. And, so it's a slightly thinner market. In Atlanta, you've got tons of different sub-markets. So, it's a big enough market to find your pocket. What we've done that I think makes us stand out is and why I like real estate so much is that there's a lot of inefficiencies in it. And when I mean that, I mean pricing inefficiencies, where even in a really frothy, expensive market, deals can be had. You can find amazing bargains if you just talk to the right people and have good relationships. And we've done that not once or twice, I think 6 or 7 times, where we found amazing prices way below market, not by doing a letter writing campaign, but just talking to brokers, bankers, and so on, and getting tips that, a deal might be coming and so on. So
I think that's a very important piece, because, establishing a new territory. Now you guys live and work up out of New York, but you're buying stuff outside your geographic area. So again,
that's right.
You start kind of at the bottom and work your way up, is that you're looking for areas that have good demographic growth coming to that area, positive rents, and probably landlord friendly, I would imagine. Now, how do you start establishing relationships with some of the brokers or the multifamily management companies in that area? Do you just pick up the phone and start calling them? Do you get a referral? Give me kind of your plan of attack. How do you get into a new area?
So what I did, and if there are new investors, this is my own personal advice, is that I would rather be over partnered on a deal, knowing I could close, than to try and do a deal alone. And anecdotally, I've known enough people and witnessed enough people, especially at, a lot of these educational real estate seminars, where people come out excited and fired up, but they've never raised a penny their whole life. And so when you go and ask someone for an investment, it can be a little bit awkward, a little strange. It takes you out of your comfort zone. So the first thing we did was to look for a partner much bigger, much more established. And we did find one who had about 6,000 units and was willing to give a new group like us a shot. And, it checked out our background, and, they basically had to stick their neck out, and we would give them a big piece of the deal gladly.
And how'd you find that?
And then this was through, I think I went to an event at RE Mentor, which was the Lindahl Group. And back in 2015, 14 and 15, there weren't quite so many real estate gurus out there with events and seminars. It seems there's a lot of them now, but this was one of the few. And I struck up a conversation, and I had to beg a little to give us a shot, and he did. And we've done 7 deals together since then. And
it's a great success story, having one conversation and you met one person that kind of changed your life.
Yep. And I would strongly suggest, unless you have a very unique background, to your first deal or two, I would strongly suggest to anyone, partner with a seasoned veteran that is willing to give you a shot. You may have to give up some control and dilute yourself. It's completely worth it. You'll make it back 20 or 30 or 100 times over by not sticking your neck out and making these really expensive errors that frequently new investors do.
And how did you do the due diligence on them? I understand about how they did it on you, but sometimes when you get together with another group that you're not too familiar with, they may own 6,000 or 7,000 doors. But how do you kind of figure out, is this person in this group going to be a good partner with me?
That kind of brings up some of the Buffett wisdom that I've kind of put in my memory, that, no amount of money is worth working with an awful partner. So, my rule of thumb is I have to like my investors and I have to like my partners. And the chemistry was there, and the disposition and the work and the demeanor. And I would ask people, what's it like to work with this guy? Oh, he's great, salt of the earth. I couldn't find anything that I didn't like. And to be quite frank, he was a guy that does things on a handshake. He didn't have to get to all kinds of lawyers and fine print. And I think that, if you have to keep going back to your document, that's not a good partnership. The partnership should be, most of it can be done on a phone call or a text or a handshake, unless you're having a business divorce or something like that. So, the chemistry was really the biggest tell. Besides, countless lenders saying nothing but good things about this guy. That was also an important factor.
Yeah, having a lender say good things about you and how you have performed with them in the past goes a long way. And so I was just trying to figure out, how you got some due diligence on your partner on that. And so you guys met the partner, and now he's been in part of some of your deals. Tell me about the last couple deals that you guys have done, and let's kind of walk through those, because I think you've had some success, and I want to kind of share those success stories with our listeners.
Okay. Yeah. So there's 3 deals that come to mind, 2 of which Old Capital was in, and the other was a loan assumption. There was really no new lender, but we bought a property in Atlanta called Winthrop Forest that was being sold by a private equity fund out of California.
And how big of a deal was it?
This was $22 million was the purchase price, and it's a 270 unit, 2000 construction, A- class in a B area. But this is a really great property. The real wrinkle here was that the seller was a multi-billion-dollar private equity fund, very sophisticated, and their fund was sunsetting. So it was a mandatory close of one of their funds, and they couldn't sell it to one of their other funds because of self-dealing rules with the SEC. So they were a forced seller. And under normal circumstances, they would have probably gotten a much, much higher price, but the deal had fallen through twice. And it was a CMBS loan, which is, difficult type of loan to assume. And it had a very difficult loan servicer that I won't mention, but they were brutal. And they required us having double the net worth and liquidity standards that an agency loan would require. So the loan was about $15 million. They wanted a $30 million net worth and I think $3 million in liquidity. I mean, they made everything difficult. It took 9 months to get this loan across the finish line, and it had fallen through twice with 2 other buyers.
Wow.
So by the time we got in, we kind of had a desperate seller that normally should never be desperate. They're, multi-billion-dollar private equity fund, but they had a deadline that it had to close by. And so for them to award it to us, every month that this property remained in contract, they required an extra $100,000 hard money for every month that went by. So, initially we put down $200,000, but, 9 months later, we're in the $1 million range hard. And they just wanted to make sure that they were getting paid for a protracted closing that we needed. So that deal was absolutely the most challenging, but we paid $22 million. It's probably worth at least $36 million right now. Wow. And we bought that 2 years and 4 months ago. So it's a home run.
John, talk a little bit about that CMBS. I mean, some people finance transactions through banks and some finance through Fannie and Freddie, and some people finance through CMBS. John, why is that so challenging? You kind of hear this story.
Yeah, I've heard some horror stories on CMBS loan assumptions, but I think Bill's kind of takes the cake. But it sounds like it ended up being well worth it in the end, as you guys have created a lot of value, and the property's worth a lot more today than it was when you went under contract. But yeah, so CMBS loans, obviously there's Fannie Mae and Freddie Mac in the market. And, Fannie Mae and Freddie Mac loans, one of the benefits of Fannie and Freddie, or one of their competitive advantages, is that you can do an assumption. Assumptions are usually pretty straightforward. You can usually get them done, within around 60 days with a Fannie or Freddie loan. And on top of that, you can do a supplemental up to 75% LTV and down to a 130 debt service cover. With CMBS loans, there's no supplemental available, for one. So whatever the loan balance is at acquisition, you assume that existing loan balance, and then the rest of the funding needs to come out of pocket to close. But then the other challenge with CMBS is really just the servicing. And so CMBS loans, they're not supported by government-sponsored enterprise like Fannie Mae or Freddie Mac. Those are private lenders, and usually it's an investment bank that'll make this loan. And usually it's a 5 to 10 year fixed rate loan, 30-year amortization. Rates are, a lot of times they're pretty comparable with Fannie or Freddie. But the challenge is on the servicing side. And these CMBS lenders, they sell the loans into the bond market, and they will hire a third-party servicer to manage these loans on behalf of the bond buyer. And these third-party servicers, really, they compete on cost. And so whichever third-party servicer charges the lowest servicing fees, that's who they'll work with. And so a lot of times the servicers are very slow to respond. They're managing billions and billions of dollars worth of loans.
Can I add something to that, John?
Yeah, absolutely.
Yeah, so one of the other things that they kind of just candidly told us is, look, we're losing a loan sponsor with I think more than $5 billion in assets to a group whose net worth is about 1% of that. You know what I mean? So they weren't thrilled, but they had to sort of honor it if we were able to meet all of their requests, because they hated losing a $5 billion sponsor to a group with, $50 million in assets. So they doubled the equity. They wanted all kinds of, lock boxes and everything else to assure that they weren't really diminishing the credit quality of the property.
Well, and I'd say too, a lot of times with a Fannie Mae or Freddie Mac loan, the servicer might be a Fannie Mae or Freddie Mac lender. It could be a group like Arbor or Hunt, and the seller might be a large borrower or a large client. of one of those Fannie or Freddie lenders. And so a lot of times when they're processing the assumption on the Fannie and Freddie side, they'll jump through hoops to make sure it goes through and that it goes smoothly because the seller is one of their clients. Whereas with CMBS loans, this private equity fund out of California, they weren't a client of the servicer. And so this servicer, they can drag their feet, they move slower. You mentioned the net worth and liquidity requirements. It can just be a very long, difficult process.
Did they tell you all that information up front, Bill, when they started
No, it was like an endless shopping list of we were just, I don't want to say the name of this servicer, but they are out of Miami, and it was challenging. It was really, really challenging.
But the good thing is you got a good asset. Turned out to be a very good asset, and that you guys have done well with that property. And let's talk about let's talk about the next transaction and how those went.
Yeah. So the next one we did was in October, and that we did with John, and it was called Forest Meadows in Atlanta. And it was a property being sold out of a portfolio where the financials were just a mess. And what we knew was, and this is something where if you're an underwriter of properties, you can't just use one measuring stick, just like you can't buy stocks and say, well, I just buy stocks with a certain PE ratio, because the financials were so bad that on paper it looked like it was a 2 cap or something. But in reality, at $80,000 a door and under normalized operating, it would be like a 6.5 cap. But this group, the financials were a mess, and they blended all the financials of all the portfolio properties. So we had to do a little bit of blind faith, and John was key in that he brought a bridge lender in that wasn't hung up on the current NOI or the cap rate. And so that deal actually went through very smoothly. And then right after we bought it, our occupancy dropped from about 95 to 85 because we had to re-tenant quite a few units. And now it's at 97.
Are you guys self-managing these properties? Because you guys are in some of these different markets. Do you have all third-party property management companies?
We use third-party for everything. Don't have any interest in self-managing. We really want to focus on acquiring more assets and running them properly, and sticking to our discipline of being value investors and value-add investors.
Yeah, I think that typically, as general partners or guys that are running the show, you should do 2 things. One, raise capital. Go out there and try to get as many people to invest with you as you can. Start to tell your story of why people should invest in your opportunity. And 2, find the opportunity. So find the new deal that's going to be out there that maybe people have looked over, and spend the time. I can tell you with Bill, he is an underwriter that looks at a lot of data. He's almost like an engineer, because I've seen him underwrite these deals left and down, and he brings out a lot of good questions. And so as an underwriter, you should almost be like an accountant. Start asking a lot of questions. And why is this? And is this really a capital expense, or is this an operating expense? Where should that be? It should be below the line. And is that a regular revenue that should be coming in, or is that just a one-time income piece that came when someone, they collected something? So Bill is very good at trying to underwrite these deals by just looking at the operating statement. He may spend not 15 minutes, but he may spend like a day and a half making sure that he's measuring 2 or 3 times and cutting once. Am I saying that right, John?
Yeah, absolutely. And like Forest Meadows, that project, I think, Bill, you went under contract in April, and we had one set of trailing 12 financials before you went under contract, and then after you went under contract, they provide you the next month of T12 financials. Completely different. And so we had to go back and say, well, wait a second, your water bill was here in the last T12, now it's here, what's going on? And we had that under contract for about 5 months.
It's the only deal that we've actually ever retraded on, because even the broker was kind of fuming about how they put on their website a certain set of financials, and the next month looked absolutely nothing like it. And I said, you just took 130,000 off your NOI, and we got a pretty sizable discount because of that. But we knew, at the end of the day, if you underwrite properly and you're not extrapolating risk to the moon, where you're effectively, everything has to go right for this deal to work. We want, 4 out of 5 things can go wrong and the deal probably will work, is how we want to buy it if possible. So, if the cap rate is so thin and everything's going right, I feel like you have nowhere to go but down. So we don't want to chase prices too much about that. And we want to keep, we want to be a realist that there's I don't care how good your due diligence is, you're going to discover something you missed, and tenants have figured out a way to stay in the property that shouldn't be there, and countless other things. So if you can build that into your underwriting, you have a good chance of doing well. And one other thing that appealed to me, by the way, just coming from Wall Street, one of the things that really appealed to me about real estate after the financial crisis in multifamily was that I believe only about 0.5%, or 1 out of 200 multifamily properties, was foreclosed on. So I viewed it as, I have a 1 in 200 chance of being wrong. Those are great odds. I love it. And that was another thing that really appealed to me about this industry.
How do you get these selling brokers to take you seriously in the marketplace? How do they know that you're just not a looky-loo? Do you put together like a marketing package on you guys? Do you have people write letters about how well you guys have executed in these deals? So how do you get the confidence from the listing broker to give you a shot on a deal like this or the next deal?
Yeah. The very first deal was a guy at Cushman & Wakefield, and I'm still grateful to him to this day for picking us. And he awarded us the Hollows, or the seller did ultimately. But, we toured a property, and I felt that my knowledge base was really strong after going to seminars for almost 3 years and reading every book under the sun, to the point where I was like, I know the answers to 90% of these questions. And I think I was able to talk the talk. And then, of course, I brought my loan sponsor, real estate sponsor with me, and he helped lend credibility. You have to borrow the credibility or fake it till you make it. And clearly, get your education and learn and network like crazy. And the other thing I would tell you is better to have too much money and too many partners than not enough, because a thinly capitalized or undercapitalized deal is a recipe for problems, especially in this kind of climate where you don't know, what the economy is going to throw at you from month to month.
That's actually a good segue into your most recent deal, which was an off-market transaction, and a listing broker that you developed a relationship with, who knows that you're a closer, showed you this property. And, it was a 280 unit property, 2008 construction. I would call it a Class A minus, located in a great submarket. And your purchase price, was $114,000 per unit. And, probably close to a double-digit cash on cash going in. So, maybe talk a little bit about how that deal came across your desk. And
Yeah. So, this business, I would emphasize to everyone to keep good relationships. And if you have something bad to say, just bite your tongue. Don't burn bridges, because this initially came to us as a tip from a property manager that we've used, and said, I think I'm hearing that this may come on the market. And so I called a few brokers, and they said, how did you hear that this was coming to market? Of course. And so before they marketed it, I made a preemptive offer, and the seller accepted it. And at the same time, we thought we would sell a property in the same general market and 1031 our equity, 1031 exchange into this low water deal. So it was a pretty complicated, from our point of view, very complicated transaction. From a lender point of view, it might be simple, but for us, it was really complicated.
Yeah, we ended up getting, it was great financing on that. We showed that one. We looked at Fannie Mae, Freddie Mac, looked at some bridge options on that one as well. But ultimately, Freddie Mac ended up providing the best terms, and that was your first Freddie Mac loan. But, I think there were 5 years of interest only and full
Yep.
leverage, really good interest
And
rate.
I think our rate was like 3.72 or 3.78. It was a great rate. I was thrilled with it.
How are you dealing right now with this coronavirus and managing, being an asset manager on this property? How are you seeing collections from April going into May, and what's the future look like in the next month or two?
Yeah, right now, knock wood, our collections are ahead of April. For the month of May, and on low water, the one that we just discussed, as of yesterday, we're at 94.5% of our collections for the month. And so we've got almost 3 weeks to get the remaining, 5.5% or so. So right now, we've seen a lot of very encouraging trends. Our move-outs have almost dried up to nothing. A lot of people that gave notice to move out have canceled and are staying or renewing. And then our demand from new tenants is probably 50 to 100% higher than normal. So 50% of our properties now have a wait list to get in, which is great.
Wow.
And I also, our view is we also want to be a good citizen. We don't want to just gouge tenants and raise the rents dramatically or anything like that. This is a unique time that we don't necessarily want to just use this to take advantage of tenants, and even tenants that currently can't pay, but they've been good long tenants for 5 years. We really would like to be, even if we could evict them, I think we view it as this person needs a chance to, get back on their feet and work out a payment plan if possible. But so far, the economics are fantastic, surprisingly.
So, Bill, what would you say, coming out of the coronavirus, you've been active in the Carolinas and Georgia.
Yep.
You've been wanting to get into DFW, but what is your and Citadel Real Estate Group? What's kind of your strategy going forward over the next few years?
We want to pick up our pace of acquisitions. We're still really selective. Clearly, the economy is going to be in really rough shape, even when the shelter-in-place restrictions are lifted. The restaurant industry, hospitality, airlines, you can just rattle off. But I think some of the things that are going to help multifamily is I think a lot of people are going to put home purchases on hold simply because their job picture is so cloudy. And the other thing is, and there's a study out from Marcus and Millichap and I think Moody's, that the number of deliveries of new house multifamily this year is likely to be 100,000 units less than last year. And so it potentially setting the stage for an even worse housing shortage than there already has been if this trend continues. So from a landlord point of view, it's a good recipe. For a renter point of view, it's going to mean probably higher rents or just harder to find really good deals.
Yeah, I would agree. And I think, a lot of the issues that people are having in these more expensive markets where people are, a larger chunk of their paycheck is going towards rent. I think that's just going to accelerate the migration to some of the lower cost markets like Atlanta and Dallas-Fort Worth as well.
Yeah, I agree. I think that then there's a Bloomberg article today about the high cost of Silicon Valley driving people out of that market. Just like here in New York, I think people are paying about as much as they can tolerate, and they're going to start really seriously considering what their options are. So, yeah, I think the Southeast, I think Texas is just fantastic. Phoenix, these markets they offer a great alternative to, San Francisco, Boston, Washington, New York.
Well, Bill, we've been trying to get you into DFW now for, maybe close to a couple of years now. And it's a tough market to break into, but obviously, Paul Peebles knows the market, and the rest of us at Old Capital know the market really well. And I think, we'll get you in. I'm confident we will, but we'll keep trying. And, you're very fortunate to be a known name in the Atlanta market and the Carolinas, and you've got great relationships in those markets as well. So hopefully you can leverage that into breaking into DFW.
You could come into Dallas, but I think that you're doing a great job in some of these markets. So,
Yeah, I actually want to let you know, Dallas is probably our Dallas and Austin are probably our, right now our biggest focus to get into. We were having such a hard time because we were bidding on nice properties, and then, seasoned veterans like Mike Becker would come in and beat us because he already had 2,000 or 3,000 units. But we were losing because people were putting in, $1 million deposits, non-refundable day one, or a 1031 buyer would come in $2 million ahead of us, and we couldn't make the numbers work. So there were a lot of big guys we just couldn't compete with. And it seems like the herd has thinned out a little. That's going to leave a little room for a group like us to come in, and, we're looking for 200 units or more.
Well, sounds good. So we appreciate Bill. Yeah, we appreciate Bill being on the podcast. Brings a lot of wisdom and knowledge coming out of Wall Street to start buying some value-added properties. What some great lessons we learned about underwriting some of these deals and paying attention about what's going on to the bottom line. So he's done a great job. If you want to get more information about you, Bill, about maybe investing with the side of you, what's the best way for them to get a hold of you?
So they can reach me by going to our website, citadelamerica.com. That's CITADEL America.com. Or you can email me at WBRANCUCCI@citadelgrp.com. And I'll respond back very, very quickly.
That's great. Well, we appreciate the business. We appreciate the great properties that you guys have purchased. And so we look forward to seeing your next transaction. So on behalf of John Brixon and Bill Brancucci, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.